everyone. Thank you very much for coming through today. Realise there's always lots of traffic, and obviously we haven't got quite everyone we'd like to have here, but thank you for those who have made it today. We're really honoured today to have Nicky talking to us. She is an extremely busy person. She's a senior economist at Nedbank. Did her Masters in Economics at Stellenbosch. Was also an advisor to the government for many years in terms of economic policy. I've seen Nicky speak before, I think once or twice. She's absolutely brilliant, so I think today you're going to be really wowed. Nicky really does focus on economic trends, understands the inflation and interest rates and what's happening, not just from a South African perspective, but obviously globally. So we really are grateful to you, Nicky. Thank you very much for coming through today.
It's a pleasure.
And thanks for your time. I know how busy you are.
Hello everybody. My aim is really to do just that, to take you through South Africa's economy, give you a sense of where we stand, also give you some indication, and this is the real trick, of how we got to where we are. Okay, so that will be the key aim of today's presentation, is to give you a sense of how we got to where we are. And in the process you're going to see what are those challenges we need to overcome as a country if we want to move to a faster growth plane, the sort of place where an economy is not only growing, but growing fast enough to encourage the kind of confidence you need for businesses to go out there, raise the capital, whether it be through banks or whether it be through the market, expand capacity, employ more people, because ultimately that's how societies progress, isn't it? So ultimately you're going to hopefully get a sense of those key challenges we need to overcome. And when you have that sense, you'll be in a position to make up your own mind as to how you see South Africa tackling these challenges. Do we have the political leadership? Do we have the institutional capacity in government and in the private sector? Do we have the level of social cohesion you need to solve some of the problems this country faces in terms of unlocking faster economic growth? And if you believe we do, then obviously you have reason to be fairly optimistic about the outlook of South Africa. If you believe we don't, you have reason to be seriously concerned. What I will do though, I won't chicken out from it, I will give you Nedbank's view of how we see things playing out over the next 3 to 5 years. And you'll get a sense of how we view these things and the requirements needed to move forward. Okay, so that's what we're going to do. So without wasting time, let's have a look at last year. Last year was an incredibly disruptive year, was it not? And we said the same of 2014, which is the worrying trend, because in 2014, if you all recall, we had that almost 6-month-long strike in the platinum mining industry. It was followed by a strike in the manufacturing industry. Your automotive chain were affected, and that had a ripple effect into many parts of the economy. And we thought, well, that's an extraordinary year. You're not going to have a 6-month-long strike repeated. And that's true, we didn't have a 6-month-long strike repeated. Thank goodness, we did have strikes still throughout 2015. But what we did have instead was really equally disruptive. We started the year out with xenophobic attacks, which crushed confidence and certainly resulted in very negative sentiment towards South Africa. From November 2014 throughout 2015, we had to deal with lack of power capacity and regular load shedding, which really took its toll to this economy in the second quarter of last year. Then we had, basically also dealing with one of the worst droughts. It started out in 25 years. Now I see the news is repeating it, or they're reporting it as being the worst drought in over a century. I don't know if that's true. I don't think South Africa's got data going back a century, to be honest, so I think that's quite a brave thing to say. So let's stick with the worst drought in 25 years. And then we had all sorts of regulatory changes that also hurt confidence and undermined activity. We had a very unfavorable global economy where things started to happen in China. We'll deal with that a little bit later on. And then, of course, we had the events of the 9th of December 2015, when we had a new dance introduced in South Africa called the Finance Minister Reshuffle, which caused great confusion and panic, to put it mildly, and really resulted in a huge amount of suspicion. All of us, by the way, were called back from leave. We had to come and man the phones. And we had to pretend as if we actually know what was going on, which we didn't. And one of the things we noted in that time was some of the comments we got from investors and from people within the market, and market traders and so on. And one particular institution out of London said to me, you know, we were concerned about South Africa, now we're outright suspicious. Okay? So that was problematic. And given all of that, the question is, where are we really? And what are really our problems? Are they really as bad as they feel? Do these events really, is it symptomatic of something deeper going wrong? And that's what I'm going to try and answer for you now when we look at actual performance. Where are we truly? Where are we really? Now, one way of doing that is to look at the nation's gross domestic product. In other words, our GDP, which in very simple terms, and it's a very simplistic measure, is just the value of all goods and services produced in a country. All right, that's it. That's all it is. And here in red, you see the rand value of all goods and services produced in South Africa, and it's reading off these secondary axes. And then in green, which is the bit I want you to focus on, you see the quarterly rate of change in that red line. In other words, our quarterly GDP growth rate, all right, as it is quoted in the press. This is the business cycle we're in at the moment, and I want you to focus really on this period here. We came out of recession second half of 2009. This recession was fairly short and fairly sharp, there's no doubt about it. It was, of course, triggered by the global financial crisis of 2007-2008, and that plunged the world economy in recession in 2008 and predominantly 2009. And given that Africa is only 1% of world GDP, and South Africa is obviously a part of Africa, and we're now the second largest and not the largest economy in Africa, you get a sense of how tiny we are in global terms. If you take our imports and exports, which is our exposure to the global economy, simplified, because there's also, of course, capital flows, that's another exposure. But if you just take exports and imports, it's almost 50% of our economy if you add them together. So that's how open and small we are. So when the world economy entered recession, so did we. And of course, when the world started to grow, we came out of recession. Second half of 2009, and we are now in what you would technically call a recovery phase. The problem is that it doesn't have some of the key features of a recovery phase. And one of the things is upward momentum. There's a recovery phase. Okay? That's been absolutely lacking in this particular period or business cycle we're in now. And there are two things that stand out about this business cycle. The first one is throughout growth has been disappointing. The second thing is that as we've gone from one period to the other, we've actually lost momentum. Can you see that? So that is very problematic. And the last 2 years have been exceptionally weak. South Africa grew by only 1.5% in 2014 and only 1.3% last year. So we are less than 1.5% economy. And the question is why? And that's what I'm going to try and answer for you now. Now we're going to get, and where's the drag coming from? How did we get to where we are, to this less than 1.5% economy? Which for another country, a mature economy, an advanced economy, would probably not be a horrible growth rate. But for a country like South Africa, where you sit with 25-26% unemployment by narrow terms, you have about 2 million discouraged workers, people who have decided that really they're never going to get work. It costs them more to actually look for work, and have just given up. Where you've got huge inequality, and we've always had historically high levels of inequality. To grow at 1.5% is just getting you nowhere. You're not actually moving society forward. You are not establishing a more peaceful and prosperous world for the vast majority of South Africans. So for us, less than 1.5% is better than shrinking, it's better than a recession, but it's still not nearly good enough. So how did we get here? Now, one way of looking at that and answering that question is to go and see where's the weakness in the economy, and then try and understand why do we have this weakness. Now, one way of doing that is simply to break the economy down by industry, and that's what we do here. Here we've got GDP. That's the same one I showed you earlier. That's the value of all goods and services produced in South Africa, the black line with the green dot in it. We index it to 100 in 2007. Then we've got all these other lines as the value added of your major industries, and they index to the same point in time. What's useful about that is that we're looking at the economy from this point in time, and we can see which industries have outperformed your average economy, GDP, which industries have underperformed your average economy. So obviously, the ones that have outperformed, they've kept the wheels on the bus turning. That wheels have been slowing down, but at least there is still some growth. So they've been the main source of growth. The ones that are underperforming, that's where the drag's coming from. That's where the brakes being applied to this car all the time. So if we look at the sources of weakness, 3 industry stand out. One is the services industry or utility, which we're all well aware of, which is power and water, and that's part of the reason why we're not growing. Okay, you're not going to produce more power and electricity unless you finish a power plant. Okay, and as you know, we found that exceptionally tricky. All right. So consequently, that just flatlines, and more recently, as load shedding has been introduced, you can see it's dipped downwards. But this is actually one of the constraints on this economy. Then the other sources of weakness has been mining and manufacturing, and they've been joined more recently by agriculture. In terms of mining, it's been a long-term weakness, if you put it that way. Their performance has been exceptionally poor in this business cycle. In fact, it's positively sickly. For manufacturing, there was the global recession, caused the recession of manufacturing as our exports came under pressure. There was a period of recovery until you came about to the second half of 2011. And since then, you see it's just literally flatlining. And it's the gap between mining and manufacturing and the overall economy is gigantic. So you've got this massive brakes being applied by mining and manufacturing. And more recently, agriculture have joined forces with them, if you like, on the dark side. You can see who's been forced to see Star Wars of late. But nonetheless, forced to see is the key point here. So agriculture is an issue, but that is this external factors as a result of this drought. Last year already crops got decimated by the drought. This year we had late rains, but it's not nearly sufficient to make a real difference to planting and to the summer crops especially. It will help the winter crops a little bit. But on the summer crops, which is maize and sunflower seed and all of those things, you are talking about a 30% drop from that low base this year. Okay, so this is still going to be a drag, but it's due to the drought, and no one can control that. And it's something all of us are affected by. The whole of sub-Saharan Africa, South America. So everybody in the southern hemisphere is facing drought. Everybody in the northern hemisphere is facing very cold weather and floods. That's how El Nino tends to work. So this has been a climate issue that we can't control, and we just have to sit through. But it will remain a negative in 2016. By 2017, if we have good rains this summer season, it will start to normalize. But so the real concern here is not this, because everybody's affected by it and it's a total external source. It is mining and manufacturing. So we need to understand, why has mining and manufacturing been so poor? If we look at mining and manufacturing, they have two things in common. We're going to generalize here because it makes it a little bit easier to understand things. Mining and manufacturing, they are both producers, aren't they? Okay, so they represent our production along with agriculture, but they represent our production, and they're also exporters. Okay, the bulk of our mining production is sold globally. About 60% of our manufactured goods are also exported. So they are our producers and they are our exporters. So you have to generalize. Why are we growing by less than 1.5%? Because our producers and our exporters are struggling. Now those are the numbers up until the end of 2015. If you look into 2016, the story is exactly the same. There's mining, there's manufacturing. Again, we use an index. That black line represents the size of all of these measures in 2008. And we now have got mining and manufacturing still below the level where it was in 2008. Okay? So they're still struggling, and in fact they're losing renewed momentum. So that is quite unsettling. And now we get to the reasons why. Well, one of the biggest factors that have contributed to the underperformance of mining and manufacturing is really the global economy. It's not been a very supportive place since the global financial crisis. But to be honest, since 2010, it started to mend and it started to grow. And we have had an expanding world economy since 2010. The problem with it is that growth has been very modest. All right? It's not been as robust as we saw during the previous upswing in the world economy. And also the sources of growth has constantly changed since 2010. Initially, the momentum to the world economy and the recovery was provided by China, and a very rapidly growing China. It was growing 10, 11, 12% per annum, literally shooting the lights out. Unfortunately, that didn't last. By about 2012, we saw that the momentum started to change, and the US became the main source of growth. And the US became the fastest growing economy in the world in terms of its impact on the world economy. And China started to slow down. And we saw a very noticeable slowdown in China. The problem for us is that China is gigantic in our lives, and especially in the life of our producers, and especially in the life of our exporters. Because remember, South Africa, most of South America, most of emerging Asia, parts of the Middle East, certainly parts of your emerging Europe, we are all producers and exporters of commodities. And China initially, when it started growing over the past 2 decades at 9, 10, 11% per annum, grew in a way that consumes a lot of commodities and in a commodity-intensive manner. Their growth was driven really by heavy industry, investment in infrastructure and commercial property. That tends to consume a lot of bulk commodities. And of course, they overdid that because it's a centrally planned economy. So they took the focus on heavy industry too far, to the point that they're now dealing with polluted rivers and people that are getting sick, and cities where people haven't for over 5 years seen sunlight, basically. And I'm not exaggerating, it's literally what I'm talking about in terms of pollution. They have green gob coming out of pipes that they don't know what it is. What do? They wash it away. I actually saw them do that. They just wash it away back into the water system. Nobody tries to figure out what on earth this is, and let's get to the root of it. Let's just wash it away. The land is big. Nonetheless, so they overdid that to a large extent, and they also overdid the investment in infrastructure and property. And to the point that for the last 4 years, you've actually had a commercial property bubble in China. You've got big cities that have been constructed with little highways and parks and all sorts of things that are standing completely empty. So they did all they could by growing through manufacturing and growing through investment in infrastructure and commercial property. And they hit a plateau, and you can see this in China's GDP. Can you see there? That very noticeable downward shift in their growth rate. And ultimately, they now have to find a new path forward. And China now really has to make that transition from being a high-income emerging or developing economy to being an advanced or mature economy. That's a very tricky transition to make. To put it in perspective for you, Argentina and Brazil in the 1960s and 70s were in that place. And they misfired completely. There are countries that have succeeded to do it, but they are few and they are far between, certainly in our time, in modern times. So China has to make this transition. It's a difficult one to do, and in order to do that, they really have to establish a greater balance between production and consumption, between industry and services, between investment and consumption. Okay? So they've got to really encourage consumption. They have to encourage services. That's tricky to do for a communist country because consumption is supposed to be despicable, okay? So that's a tricky place to go, but they're trying to do that. And now, in other words, China is growing at a slower pace and it's growing differently. Services are making up a bigger portion of the growth that we are seeing at the moment. If they're growing slower, that means they are importing less. Remember, their imports are our exports. Okay. Plus, they're growing in a different way. Services now make up a bigger portion of their economy. That means of the imports that have been affected, commodities have been affected particularly harshly. And we are producers and exporters of commodities. So the slowdown in China has been bad news for us, because this is what's happened to China's imports. Initially grew at a slower pace, and then it started outright shrinking, which was last year, where we saw Chinese imports fall 12, 18% year on year on a month-on-month basis. And the reason for that is, and why the impact on us has been so significant, is because China is so enormous in the commodity markets. I picked 4 commodities here to illustrate the point to you. But really you can go and pick any commodity. You will see the same situation. I took iron ore, aluminium, copper and nickel. China consumed 60% of the world's iron ore production. Okay, 50% of its aluminium, 50% of its copper, 45% of its nickel. And in the years that its imports were doing this ridiculous upward surge, and it was predominantly driven by demand for commodities, the world responded. And you saw huge exploration in Africa, in South America, in Australia, to add mining capacity to the system. You also saw expansion in your sort of commodity beneficiated manufacturing, iron and steel, aluminium, and so forth. Now China's growing at a slower rate. It's also growing differently. Services make up a bigger portion of its growth. Manufacturing and industry is less of it. Investment in infrastructure, well, there's an overhang, there's a bubble that needs to absorb, so that's also way less of the growth we're seeing at the moment. And that means demand for commodities globally are falling. So China now consumes less commodities, it demands less commodities, you still have all this excess capacity. So you have surpluses in virtually every commodity you can talk of or think of. And that means in that void, prices have been falling. So why have we been growing at less than 1.5% last year? Because the cumulative effect of a commodity price downturn caught up with us. It's not new. China's been slowing since 2012. Commodity prices have been falling in earnest since 2012. Okay? So we're in the middle of a commodity price downturn. We're at the beginning of year 5 of a commodity price slump. And that is why our mining and manufacturing has struggled. That's one of the key reasons. But now, the question is, how long will this last and how severe will the impact be on us? Well, it's already been significant. We're growing by less than 1.5%, to put it in perspective. How long will it last? That will depend on two things. One, how fast the world economy grows from here on out, and how big those surpluses are in each and every one of those commodities. And if we say the world economy needs to absorb these surpluses, what do we mean? Well, essentially, it means that your high-cost producers shut down. Okay? They have to shut down. That reduces the supply to the market. And your low-cost producers, they take a hit, they get hurt, but at least they get to live and ride the next commodity price upturn. So the big question is, and how badly it will affect us, is what are we? Are we a high-cost producer? Are we a low-cost producer? Or are we somewhere in the middle, that we are a competitive producer? Well, just to show you how exposed we are to this, over 61% of our exports are made up of commodities. 37% of that on its own are pure mining. Okay, pure mining. 35% of our exports are essentially 4 commodities. Coal, gold, iron ore, and platinum. That's it. Okay? So China matters hugely to us. And where we fall in the cost structure matters hugely to us. So what is your sense? Are we a competitive producer?
No.
No, obviously not. If we were, and in many ways the short way of answering this question is, if we were a competitive producer, why are we bleeding losses in mining and in iron and steel and aluminium producers? We know we're bleeding losses. And we've been bleeding losses for quite some time, and platinum and coal and all of these industries. So no, we are not a competitive producer, but there's good reason for that. And while we can, as South Africa's government, as businesses, we can't control the commodity cycle. Okay, that's something everybody in the world is exposed to. But we can control whether we are a competitive producer or not. So if we want to get to those challenges that we need to solve so we can grow faster, we have to go back to why are we not cost or price competitive? And here are the key reasons from what we can see. Our biggest problem really is that the cost of production has surged. Okay? And there are a couple of factors that have contributed to that. The one being, of course, the negative relationship between the cost of labor and the productivity of labor. Now, in South Africa, we tend to want to rationalize everything. We want to, motivate why things are the way we are. But sometimes it's useful to take a cold, hard look at the fact. The point is that we are no longer competitive. We've had 5 years in which wage growth has generally outstripped inflation in both the private and the public sector. In the public sector, it's been far more pronounced than in the private sector, but nonetheless, that has been the norm. At the same time, productivity growth over the past 5 years initially was positive and started to slow down. Okay? Last year, it shrank for the first time since the recession of 2008, 2009. So in other words, that gap keeps growing. And there's a lot of reasons for it. Some of it is legislative. We've had a lot of changes in the labour legislation over the past 5 years. We also have a situation where a lot of that changes have certainly disrupted the balance of power within the labour market and certainly handed a lot more of that over to unions. Unions are far more aggressive and they tend to get what they want. Okay? They do. If you were a betting person and it was a union against anybody in this country, You put your money on the union and you double up. Even against government, they 9 out of the 10 times get more than government wants to give. They the winners over the past 5 years. The situation was far more balanced prior to that, but over the past 5 years, Labour certainly have been the winners. Yet they've been incredibly successful in convincing us all that they are outright the losers. There is part of the success, okay? That's part of the trick. Nonetheless, they have been the winners. So that's been a negative, but the biggest problem is the productivity. And there are historical reasons for that: lack of training, lack of education, and really still a very inefficient education system that's not producing the sort of quality labour force you want. You could say, are companies spending enough time on productivity? The one thing, though, that is a problem in South Africa is that remuneration is separated from achievement, from performance. And until we don't bring those two together, it's hard to imagine how we're actually going to improve productivity other than superficially or the painful way. Companies can easily improve productivity by doing what? Retrenching workers. Which is the way they've done it, which is unfortunately incredibly destructive. So we need to have some hard conversations there, but that's been a big negative. Of all the foreign companies we've come across and we've spoken to about South Africa and about their world, whether it be in the production side, certainly I won't mention names, but they all tend to say that for them, that's the biggest negative about South Africa. Then there's smaller factors that is added to the cost of production: inefficient public services, sometimes the complete unavailability of public services, which means the private sector has to take that cost upon themselves. We've also had corruption, red tape, legislative burden. That is sometimes not a uniquely South African thing, but it is a global thing. Okay? After September 11, after the global financial crisis, the legislative burden for everybody has increased dramatically. But it adds a cost to your production. And then the next one that is undermining the cost of production and adding to that burden is just the lack of economic and basic services. And what am I talking here? I'm talking about access to economic infrastructure and the cost of that infrastructure. We have a shortage of economic infrastructure. We've been well aware of it for probably over a decade. We knew this was coming. We didn't sufficiently plan for it, and we didn't efficiently plan for it. Okay? And the problem with that is now that it has become a burden on the private sector, and it's actually making their lives very, very difficult. And this now relates to the lack of power generating capacity. That's the obvious one, but it's not the only one. We also have inadequate transport and logistical capacity. And some people have benefited greatly from that. If you are in the trucking business, you've made a killing out of this country because we have the wrong mix of transport infrastructure between road, rail, and port infrastructure. And that does not help either. We've got a drought this year. We've got to import over 1 million tons of maize. We've got zero excess capacity at Durban Port. Zero. They can't move the conveyors from one place to the other. Now they've got trucks scooping up the maize, driving and then tipping it into a silo. They got the trucks going back. It's insane. You can imagine the cost. They haven't got the rail capacity to take it from the silos at the port to the various refineries or food processing plants. That also has to go by truck. It's ridiculous. Every truck can only take this little bit. So the cost just escalates and escalates and escalates, which is why food inflation is where food inflation is and why it's going there so quickly. Okay, so all of that is an issue. Lack of transport infrastructure, water, telecommunications. And when something is scarce, the cost of that, of course, escalates. You just think about power tariffs. We've been building over 8 years on essentially 2 power plants. One was supposed to be finished in 2012, that's Medupe. Kusile was supposed to be done in 2014. If we had stuck to the original schedule, we would have had no power issue whatsoever. In the meantime, what do we have to show for 8 years of building on 2 power plants that have cost us 300 billion rand? I mean, you can't even conceive of the numbers. We've got 1 generating unit from 1 power plant to show for it. One generating unit. There's supposed to be 12 from the 2 power plants combined. 8 years on 1 generating unit. It is just astounding. It's mind-boggling. And that's cost us 300 billion rand, and we've all paid. Because electricity tariffs have gone up in absolute terms since 2008 by 310%. Okay, so you're a business now. You're trying to stay as price competitive as you were prior to that. One element of your cost structure, power tariffs, broken through Earth's atmosphere. It's heading towards Mars. It's in a competition with Elon Musk to become the first permanent resident on Mars. And you're trying to stay as price competitive as you were prior to that. Okay, so that means you've got to cut everything else. But you can't. You can't cut labor. You can't cut wages. Because the unions are too powerful and you don't really control that. What do you control though? The number of people you employ. And that becomes very destructive. Okay, so that's just to put it in perspective. The other thing that the lack of economic infrastructure does is it puts an absolute limit to your growth rate. If you've got insufficient power capacity, you can only grow so fast because there isn't enough spare capacity on the system to allow for new businesses to start up, new factories to start up. And the IMF and the Reserve Bank did a lot of work on this. And they said with South Africa's existing capacity, the best growth rate we can achieve under perfect conditions, in other words, a world economy booming, commodity prices bouncing back, under perfect conditions, with our existing power capacity, we can grow somewhere between 2 and 2.5%. So even in a perfect world, we can only grow by 2.2 to 2.5% unless we build more power plants. You understand how it limits your economy? All right, so this is a negative. So to put it very simply, no, we are no longer a competitive cost producer. And the downturn in the commodity cycle, we're into year 5. It's now catching up with companies. They can no longer absorb the losses. They've got to make the difficult decisions. We saw that happening towards the end of last year, coming into this year. All the mining firms, they are doing one of two things. The ones that are a little bit more competitive have all just canned capital expenditure. That's the first negative for growth. Why? Because the expanding capacity determines how fast you'll grow in the future, how many people you will employ. So most of them, that's the easy option. If you have to go for a downturn, you can your capital expenditure. So they've done that already. Some of them are still bleeding losses. So what's the next step? You retrench workers. Now the moment you retrench people, that now becomes a bit of a ripple effect into the rest of the economy. Because now there are less people earning an income, less people with the ability to spend, and now even services start to stumble. So can you see why our growth rate is slowing? The weakness from mining and manufacturing, from production and exports, is starting to spill over to services now through retrenchment, through lack of income. Okay, so just to put it into some perspective. Another negative in South Africa, well, I don't know what happened.
Sorry, no, it's timed out.
Oh, because I haven't touched it.
Sorry, yeah.
All right. Another negative, we can chat about this, you don't need to see the graph, is policy uncertainty and, of course, political turmoil. All right, that's another negative in the case of South Africa. Policy uncertainty is a big one because that also adds to the risk of undertaking capital expenditure, apart from the fact that there's not enough infrastructure. What are we referring to when we talk about policy uncertainty? Government gets very sensitive and upset when we speak about these things. And they'll say, we don't know what your problem is, because we've got the National Development Plan, don't we? And you all said that's a good plan. And it's true, we did say it was a good plan. And it is a good plan. It was based on a very sound methodology, the way they went about it. They did a lot of research. It was very thorough. You can't criticize it in any way. The problem, though, is, and our concern is, that even if you look through a magnifying glass, it's very hard to find evidence of the National Development Plan actually manifesting itself in government policy. And what do I mean by that? In industrial policy, in labor policy, in trade policy. You don't see the evidence of it, and that's the problem. And if you look at all the regulatory and legislative changes over the past 5 years, they all have two things in common. The first thing, they reduce the rights of the private investor. Immediately, you introduce uncertainty. The second thing they do is they increase the right of government to intervene at its discretion in any given industry. Okay? Again, an element of uncertainty. What is the rules of the game? Where does the private sector's responsibility begin and end? And where does government's responsibility begin and end? And in many ways, there's no answer here of what's the perfect model. What we do know from looking at economic history is you just have to decide, and you've got to stick to it. So if you want a bigger government, make up your mind, decide where that limit is, and stick to it. It is the changing of the rules that is the destructive thing. All right? That's the destructive thing. All right, so all of that adds to the uncertainty. And so what's been keeping us growing? Well, here you go. Let's go back to this graph. It's really been services. You look at all the industries above the line, it's been your services industry. What do they rely on? Domestic demand, domestic spending. Now what's been driving domestic spending and domestic demand is this yellow line. I'm going to show you how now. It's called government spending. So what's propped us up? Why are we at least growing, even though it is very slow growth? Government services have propped us up. Government spending has propped us up. And what has government been spending on? Two things, okay? Basically, the civil service. They've expanded the civil service, they've employed more civil servants. The second thing they've done is they've paid them a very nice above inflation wage increase, okay? And how does that support the economy? Well, you create consumers, don't you? Now there are more people earning an income, more people with the ability to spend, and that's how they've propped up the services industry, which is why it's kept the wheels on the bus turning. The problem with that is you can do it for a year or two. Many governments do it. There's nothing illegal about it. But provided you can finance it, provided the burden of the state does not become too big for the size of the economy. In our case, the state became too big for the size of the economy some years ago, all right? So we've done as much as we can do with this model, just to show you the gap. This is employment. These numbers are courtesy of the South African Reserve Bank. There's total employment in South Africa, indexed to 100 in 2008. Here, you have private sector employment, which relates back to the cost of production. Okay, the thing that has kept industries at least alive was the fact that they didn't have to employ. It's the only thing they can control. So there was a bit of a recovery in private sector employment, then it completely flatlined. Now as mining is struggling, you're seeing retrenchment at the margin. So this is drifting lower. It's not as bad as this period here, where we went into outright recession, but it is nonetheless drifting down. Where's all the jobs been created in this business cycle? In the public sector, in government. And the gap's enormous. What's the problem with this? It's completely unsustainable. Because every job created here, every income paid here, has to ultimately be financed by taxes raised here. But you're not creating any more taxpayers. Because the private sector is not employing. Okay, so it's no surprise that some time ago we ran out of tax money to fund this ever-expanding civil service. That's just the employment side of the equation. This is the wage side. This shows you the real wage bill, adjusted for the effects of inflation, from 2008 till late, again, indexed. You can see for the private sector, you've had wage growth of about 2% above inflation. Okay, so that's where wages have settled in the private sector per annum. In the public sector, it's been the place to be, people. Even Mr. Nene told us before he got fired, or asked to leave, or redeployed, as they would put it, that it has been the place to be. Of your top 10% income earners, or taxpayers, of the top 10%, the bulk now come from the private sector, from the public sector. But of course, if you think about it, the public sector is paid out of tax money and they give a little bit back. So it's not your final taxpayer. That's why you need job creation in the private sector. So it's really astounding. There you're looking at wage increases per annum somewhere between 8 to 10% above inflation. Astounding stuff. So no surprise really, we ran out of final taxpayer money to fund this racket quite some time ago, and we've essentially been borrowing. Okay, so we're running deficits of over 3% of GDP. That 3% level that you might often hear in the press is absolutely critical. And in many ways, it's a hard limit. Because in economics, we have seen over and over and over. If governments borrow at a rate of over 3% on an annual basis, they're adding to their national debt burden way too rapidly. And as a banker, I can tell you, debt does not escalate in a straight line. It's a very steep curve. Why? Because there's something called interest that gets added to it. So before you know where you are, you're just adding to that big debt burden too rapidly and your national debt starts to run away. So we've been running deficits of over 3% of GDP for what is it now, 7 years. And that means we're borrowing money to pay public sector wages and salaries, which is just not acceptable. And as a result, this is what's happened to our total national debt burden. It's gone from very low levels by global standards, okay? We were a shining example to the rest of the world at some point. Again, you can go back almost 5 to 6 years ago. Where did the damage to South Africa come over the past 5 to 6 years? You can read into that whatever you want to. I, on the other hand, am not allowed to speak about it. Now, as you can see, it's escalated very rapidly. Our debt is now over half the size of our economy. Is it the worst debt number in the world economy? Ooh! Okay, so you've lost something there.
Okay.
I could have possibly destroyed it by now. Is it the worst debt number in the world economy? No, by no means. No. That's not the point, though. It's the direction we're heading. Okay, that is the point. We're heading in the wrong direction. To give you an idea, for Greece, for example, their national debt to GDP ratio is 185%. So it's almost twice the size of their economy. Okay, but the difference between us and Greece is enormous, because once you get to that 60%, okay, so once your national debt to GDP ratio goes over 60%, that's when a nation becomes vulnerable. Because now you're running the risk of falling into a debt trap, a situation where you essentially have to borrow money just to service the interest on your existing debt, which is where Greece has been, where Argentina has repeatedly been, where Brazil has repeatedly been, where Venezuela and Bolivia and all those other shining countries, the models for Malema, has been for decades, literally decades. Okay, so but the difference between us and Greece, though, is that, of course, Greece has an uncle. It's a bitter uncle. It's called Germany. And it is willing to pay the interest on Greece's debt. We have no such uncle. All right? We don't have this concerned and bitter uncle. Consequently, we're on our own. If we carry on at this pace and we keep borrowing at a rate of over 3% of GDP per annum, within 3 years, our debt to GDP ratio will be over 60%. Then we're in the red zone now. Then we're in the vulnerable place, and that's the problem. All right, obviously, your global rating agencies, what is their function? Their function is to warn people, investors primarily, of the risk of investing in a country. And they do that by rating countries. And they look at objective measures, and obviously there's an element of judgment involved. And yes, many countries have been very, very skeptical about rating agencies. And that level of judgment, or that element of judgment that is involved in establishing these ratings. And that's a whole different debate, and it could last essentially a whole day if we want to do that. The point, though, is whether you agree with their methodology or not, investors follow their advice. Okay, so capital is driven by what happens in terms of these risk ratings. When you get a downgrade, it means the risk of putting your money in that particular country has gone up. And that doesn't mean people won't still put their money in that country. They are taking a higher risk, and what will they want for a higher risk? A higher return, exactly. And unfortunately, that's a problem if you're not growing. Okay, we're not growing. We're growing by less than 1.5%. So if they put their money in the JSE, it's quite toppish, it's quite pricey, okay, and earnings growth is slowing. So they're not getting the higher return for the higher risk there, are they? So what is the other asset left that they could put their money in South Africa? Government bonds or interest, money market. And what determines that? Interest rates. So if you've got a higher risk, you're going to have to offer, if you're not growing, provided you're not growing, higher interest rates. That's essentially what it means. All right, so we've had downgrades, a series of downgrades. And what they're really saying to investors is, whoa, if you put your money in South Africa, remember, they're running a deficit of over 3% of GDP for over 6 years now. Their debt burden has grown very rapidly in 6 years. It's not at a critical level yet, but that doesn't look like it's going to slow down anytime soon. The worst thing about South Africa is that they're borrowing money at a rate of over 3% of GDP, not to finish power plants and build road networks and have schools pop up in suburbs that have been completely neglected for decades and decades, and having hospitals pop up. They're not spending their money on that sort of thing. No, they're spending it to pay civil service wages and salaries. That's what they're borrowing money for. Investors, beware, be careful. If you're going to put your money in there, you want almost an Artesian-like return. Okay, so we're now at that critical juncture where we are one notch above what is called speculative or junk status. The very subtle term for it is sub-investment grade. Those are the very sensitive analysts. They're not going to give you speculative, which is an ugly word, or even worse, junk. But it is junk. I went to America, it was about 3 weeks ago. I was in New York. I was trying to sell Africa and South Africa to foreigners. And As you can imagine, it's a hard task at the moment. We call it live for our country sessions. We're very good at it by now, so don't worry, we keep a straight face. And we keep going. And in the audience in New York, the one evening, there was a Brazilian. And they were last year downgraded to junk. And he said to me, junk status is the worst thing. He said it is a little bit like, it's worse than divorce, he said to me. You know, you lose half the value of your assets and you're still stuck with your wife. I then pointed out to him that I am in fact a woman. And the worst bit about it is he seemed surprised. It's like he had temporarily forgotten or something. In any case, the bottom line is that is where we could go if we don't turn this around. And in the midst of that pain, we had the events of 9 to 12 December, we had free finance ministers. The National Treasury is ultimately that determines whether we're going to make or break in terms of our credit rating. And now you're chopping and changing, and you just look completely incompetent. You're also raising suspicions. Why are you doing that? Nene was a very respected finance minister. In fact, I would have to tell you, it's not Nene's fault that the public sector wage bill exploded. That happened in Provincestead. It wasn't Provin's fault either, but the point is it happened in his time. Nene actually started to implement very tough measures, and he got no thanks for it whatsoever. I mean, I can take you back a little bit in what we call the Nene effect. Can you see that? And that was just in a year. So he was in just 1 year already making progress no one else even managed. So people just didn't understand it. So if you're getting rid of a competent person and you don't give a reasonable explanation, it is only reasonable of the markets to assume the unreasonable, isn't it? And that's precisely what they did. And of course, that's where that outright suspicion comes from, that the political leadership is no longer acting in the interest of the broader economy, in the interest of the broader population, but in the narrow interest and the narrow financial interest of a few connected individuals. So when Pravin Gordhan was finally reappointed to try and steady this ship, he had an impossible task, but there was only one thing he could do. He had to show that they will cut the deficit. Okay? He had to show that. There's their plan. They want to bring deficit down to below 3% of GDP within 1 fiscal year. And the only way to do that, really, is yes, you can up taxes. But in South Africa, you already have such an aggressively progressive tax system. Okay? And really, now you're starting to hurt growth, which is the last thing you want to do. So your options with that is very limited. So he didn't go for upping income taxes even further. Nene did that. He went for indirect taxes. In fact, very obscure indirect taxes. I think there's a light bulb tax we didn't know about. He basically told everybody at Treasury, go find me the forgotten taxes. I'm going to sneak them up a bit to boost my income. Which he did, but it's fine. It's less damaging than going on corporate company taxes and personal income taxes. Okay? So that's the one thing he did. But the key here, ultimately, is to cut the size of the government. You really want to solve the problem, you have to cut the size of the government relative to that of the overall economy because it's become too big. And that's tricky, because you can't do anything about wages, because as I told you before, when it's government against unions or private companies against unions, unions win. And the unions won last year against Minister Nene as well. They got out of him more than he was willing to pay. They got a 1% above inflation wage increase. All right, so you can't do anything about wages, and it's going to be touch and go. Because he's got a forecast for inflation there. But he could be wrong. He's assuming inflation will average 6.9% this year. And it's already in March at 6.3%. However, food inflation is near 10%. It's almost double digits. We're in the middle of a drought. Inflation could turn out to be 7% average this year. 8% average. What is wages then? It's 9%. That throws his whole budget out. You understand what I'm saying? So it's going to be touch and go. So he can't control wages. So the only thing Pravin Gordhan can control, just like the only thing Minister Nene could control, was employment. Now they're starting to see the dilemma in the private sector too. The only thing they can control is employment. And he says, so until we go back to the unions, until we go back to the mess in the labour market and why it's dysfunctional, we're not going to solve unemployment. And it doesn't matter who owns the company, whether it's a black person or a white person, they're going to encounter the same obstacles. So we need to address the obstacles. You understand what I'm saying? All right. So ultimately, this is what he's come up with. And the trick to controlling the public sector wage bill and limiting its growth to 8.4, 6.7, and 7.1% was to stop employing and to retrench public sector workers where there is no need for them. Okay? And I have to say, it seems that there is scope for downsizing in the public sector. All right. So, but what does that mean? Remember, what got us growing by more than 1%? Public sector employment and wages. Now what's going to happen? It's going to fall away. So that's also becoming a negative.
Sure.
Okay, that's also essentially becoming a negative. Added to that, households now also have to still deal with very high debt burdens. Debt in South Africa is still around 76, 77% of disposable income. Our ability to cope with this debt burden is determined by the interest rate. Okay? And what's happened to interest rates? That's gone up. Okay? It's gone up very mildly by South African terms. I know people moan about it. But really, the Reserve Bank has only increased interest rates by 2% over 2 years. That's 1% a year. That is positively mild. It's almost non-existent by South African terms. All right? So yes, interest rates have gone up. And unfortunately, as a result of that, debt service costs have ticked up. That's now eating up a bigger portion of South Africans' households' disposable income. And that means they've got less available for discretionary spending, don't they? All right, now, what will happen to interest rates? Will it go up even further? That will depend on what happens to inflation. Now, there are a couple of forces weighing down in terms of inflation. The biggest risk at the moment is food price inflation. Listen, it's rising. It's almost already at 10%. Okay. So it was 9.7% in March. Many of the companies we've spoken to, again, I won't mention names because it's a sensitive issue. They are clients of ours, have indicated that they believe that is in the food business, that you're looking at food price inflation of between 10 and 15% this year. Okay? That is substantial. So that also eats into the pocket of the consumer. Now let's look at the consumer, which is your source of domestic demand. The main source of employment in the private sector, which has been mining and manufacturing, well, they're retrenching. And government, they might not retrench immediately, that might only come next year, but they're not employing. Okay. Wage growth on both sides have to slow simply because companies are making losses. And government has no more money left and that wage deal is set anyway. Okay. So your income employment dynamic, that's turned marginally negative. Now you add to that debt, you add to that rising interest rates, you add rising food inflation eating up disposable income. The next negative is oil prices. I'm going to deal with oil prices first now, just because I want to get it out of the way. This is what's happened to Brent crude oil prices. Can you see that? Now, initially, the Reserve Bank was lucky over 2014-15 because oil prices literally halved. It collapsed. And when it was falling like this, it brought inflation down. Okay? Why? Because oil prices were falling faster than the rand was depreciating. Now oil prices are reaching its trough. Can you see that? It can't fall much. It's not going to fall by that same amount this year. You agree with me? It's going to be bouncing around here at the bottom. It might even start to drift upwards. Now, it's no longer falling faster than the rand is depreciating. So what's going to happen to petrol and diesel prices locally? It's going to start going up. That becomes an inflationary factor too. Then the next enormous inflationary factor is the rand. Okay. Now that's already an inflationary factor. Last year the rand lost 45.5% of its value against the US dollar. Alright? That's just astronomical. 45.5% of its value against the US dollar. The problem with that is that the cost of imports for the entire economy has gone up. And so far companies have absorbed the weaker rand. But for how much longer will they do it? Well, the evidence is starting to come that by February, March, we have seen, if you look at the inflation numbers, that companies are now starting to pass rand-induced cost increases onto consumers. For over 4 years, though, before you get angry with companies, the rand's been depreciating for an extended period of time. And companies have absorbed that throughout that period. So they've reached the point where they can't take it anymore. They have to restore their margin. And that process has started. Now, so you've already got got last year's depreciation that will slowly work through in the form of higher prices. Is there a risk of even further depreciation? Yes, obviously there is. What is the biggest risk? We get downgraded to junk. Just to illustrate to you what happens to a country when they get downgraded to junk. Here is Brazil, okay, in blue. Now you'll often hear people say, yeah, but even if we do get downgraded, the rand has fallen by so much, it's already in the price, it's already discounted in the value of the rand. Not true at all. Brazil, like everybody else, was depreciating. Can you see that? There is where it got downgraded.
Sure.
Yes, it did pull back. But can you see that it's come nowhere near to where it was prior to being downgraded? So there's still a knee-jerk reaction in the market, irrespective of how much the currency had already depreciated. When will we know what will be our fate on this sovereign risk rating downgrade? Well, we will know. There's a risk June. We don't think they're going to move in June. Minister Gordon, though, seems very worried about June. I don't know why. And then the next risk is December. So another holiday list December for me. But the next risk is essentially December. All right? So that's when they bring their next update through. We're worried about S&P. If two of them downgrade us to junk, we're in trouble. Because remember I showed you government runs a deficit of over 3% of GDP. We've got debt of over 50% of our economy. Of that debt, 40% is financed by foreigners. That's another thing that's changed over the past 5 years. What does that amount to in rand terms? That is 620 billion rand. Okay? If we get downgraded, the bulk of that is pension fund money. They've got rules. They cannot invest foreign funds in countries where you don't have at least 2 rating agencies above investment grade rating for that country. So if we get downgraded by 2 of them by December, that means 620 billion rand has to leave almost automatically, which is why you'll still have that knee-jerk reaction in the rand down. The Reserve Bank is painfully aware of this. So this will weigh on them in terms of interest rates. The other thing is just generally for emerging markets and commodity-producing countries, the world's not very favorable at the moment, okay? Because essentially, you've got China slowing, you're in the middle of a commodity price downturn. The worst of that slump in commodity prices is probably over. It's probably past us, okay? But we're now at the bottom. So it's the same story for all other commodity prices as oil. You know, is the worst of the decline behind us? Are we in the trough? Are we going to slowly edge up, or are we going to bounce around at the bottom for a while? Let me tell you, markets, whenever you're at a peak and a trough, is insane. That's when you can burn your fingers. That's when there is such volatility and uncertainty. And the market behavior throughout last year and into this year suggests we are near the trough in commodity prices. Just because of the volatility, the erratic behavior we've seen. 1 month it's up, the next month it's off. Then it's risk on, then it's risk off. Then it's pro-China, then it's anti-China. Then it's yes US, then it's no US. It's literally, you would have whiplash if you sat on my seat for the last 2 years. Okay, so all I'm trying to tell you is that we're probably near the bottom, but that's where the biggest pain is taken. Okay, because it hits companies with a lag. They can bear the initial drop, and then the pain starts to accumulate. So for the rand, unfortunately, like all emerging markets, there will probably be further slowdown in China. Commodity prices, the worst of the pain is probably over, but that trough could be a very long one. And that means most investors are probably going to be very wary of putting their money in emerging markets. Okay, so that's the first negative for the rand, also from just the general terms. The other thing is investors globally are going to argue, why would I take the risk? The US is growing. If you invest in the US equity market, you know, you just buy a tracker fund, you're going to be fine. You're going to get a decent return. Plus, there's no risk. There's very limited risk anyway. Plus, the US is growing rapidly. They can't keep leaving interest rates at these low levels. All right? So really, what we have seen is that global funds have shifted out of emerging markets. Out of emerging markets, there's emerging market equities, and into advanced economies. Can you see that difference? The gap between these two, which is this green line, explains the movement in the rand. Until we get to December when we fired our finance minister. Then it's South Africa specific things dragging us down. But the rest of the time, it's just emerging market risk aversion that has been moving the rand in one direction. And you've got this massive shift out of emerging markets into advanced economies. But can you see, you've got a lot of mini rallies here. Can you see that? Okay, so bad news on China, commodity markets, they sell out of emerging markets, they buy into advanced countries. Okay? Then they sit with their advanced country assets. If they're in equities in the US or the UK, they're all right. Okay? But if they're in government bonds in the US Treasuries, they're now waiting for the Fed to hike interest rates. Waiting. Okay? Remember, the US base lending rate is only 0.5% now. It was 0.25%. The first hike only took it up a whopping 25 basis points to an amazing 0.5%. A 0.5% is your return. Now you're an asset manager in New York. Okay, you're sitting with billions and trillions. But you still have to satisfy your clients. Now you're making only a return of 1 to 2% on your investments sitting in advanced countries. So now the pressure's starting to build. They're saying to themselves, okay, all right, we can't not at least show 5 to 6% growth in our book. So let's quickly rush to South Africa, get some government bonds. We guarantee 10, 11%. And then if Malema says something stupid, we sell quickly. Okay? So this is essentially how this game is played. And then you see them coming back to emerging markets. What happens? The rand pulls back a bit. What was April? It was such a spell. And that's the thing, we have incredible volatility at the moment, and it's probably going to persist. But even with these little mini cycles, there's an overarching cycle, isn't there? And that's the shift out of emerging markets into advanced countries. That's also negative for the rand. So from the Reserve Bank's perspective, I'm going to skip this one, they really, they're in a very difficult place. They know this economy is vulnerable. They don't want to kill the patient. But in reality is, their job is to maintain stability in prices and financial stability. Now, stability in prices, you've already got inflation moving up. It's already above their target range. They've got to keep inflation between 3 to 6%. In March, it was 6.3%. You've got oil prices starting to turn. You've got food prices escalating. And you've got a weak rand. Historically, it's fell in 1 year 45.5% against the dollar. That's going to be transferred into higher prices. Plus, there's still downside risk to the currency. All right? And you've got inflation over 6%. So inflation is going to keep rising. It's probably going to peak at close to 8% later this year and stay above the Reserve Bank's targets range for close to 2 years. So is 2% in 2 years enough to contain price inflation? No. That means there will be further hikes. The other problem is the Reserve Bank is almost now tasked with the job of keeping capital flowing into South Africa. If you get a downgrade and you're not growing, how do you attract capital? You have to up interest rates. Remember, 40% of government debt is financed by foreigners, so it matters. Also, as a nation, we run a deficit. Okay, we import more than we export. So if you want the dollars and the euros to stock your shops with imports, somebody needs to be pushing up the return we're offering foreigners, because they've got to give us those dollars and euros willingly. That unfortunately falls on the Reserve Bank. So no, we do think they will hike further. Will they hike later this month? No. Because the rand did pull back in April, okay, and inflation receded a bit from 7 to 6.3%. It's all temporary stuff. So we'll all reverse in the months ahead. But nonetheless, they'll probably decide, okay, they moved by, what was it, 75 basis points, huh? And just the first 3 months of this year. So they're probably saying, okay, you're all shocked. We're going to give you a breather, adjust, save a bit more, and then come probably July and September, they will move. They will, in our opinion, hike further, another 25 basis points each, taking prime to a peak of 11%. Now, if you think about it, that's still moderate in South African terms, given the things that have transpired. However, all of this assumes we avoid downgrade to jump. Okay, all of this. What's the upside to interest rates? Well, if you look at Brazil, it can go over 16%. Okay, in our case, it could be our Reserve Bank doesn't panic easily, and we used to rand instability. Okay. So I don't, and we've learned good lessons. They're very competent team. So I don't think they'll do the Brazil-Turkey thing, move 5% in interest rates overnight to try and protect the currency. They don't want to do insane things like that. But you will probably see that interest rates will peak higher than the 11% we're currently anticipating if we do get downgraded. It will probably peak somewhere between 13 to 14%. But I don't think much more than that. What does that mean, though? For the consumer, it means income will be under pressure. The financial environment is unsupportive. It's draining their income in the form of higher inflation and higher interest rates. Therefore, the slowdown we've seen in disposable income and consumer spending continues. If we put all of this together, we're near the end of my depressing story, I promise you. If we put all of this together, this year, where are we going to get the growth from? Okay, what's going to be the boost? What's going to make us grow faster than last year's 1.3%? Can it be mining? No. Can it be manufacturing? No. Can it be agriculture? No. Can it be government? No, please. Even though that would help in the short term, no, please. Can it be the consumer? Can it be other services industries? No, because they feed off that basic base. And that is stagnant. So this year, growth is going to be very weak in our opinion. Most forecasters out there has got us growing by less than 1%. Okay? We actually do see a little mini recession. It's a technical recession. It's nothing like this Spain. Okay? And that's in the second and third quarter. And then we come out of it and we continue to grow, but very modestly. And overall, this is the numbers we see. 0.2% growth this year, 0.9% next year, 1.5% in 2018. Listen, we can grow by more than that. But that means we need policy cohesion. We need strong leadership. We're going into an election, okay? So we're not going to get it this year. Maybe we get it next year. Maybe, you know, there's greater clarity and there's a less turbulent political scene. But then you have to say, I don't think in this election the EFF is going to get smaller, do you?
Probably not.
So what would make Parliament more orderly? If they're not going to get smaller, but they're going to get bigger, the red division side is going to grow, it's not going to get more orderly. We're not going to, you understand what I mean? So that seems unlikely. So yes, it can be higher than that if we make the right sort of decisions. The one positive thing, though, that I can tell you that happened, is you all remember the US, not the US, the new visa regulations, okay, that they implemented. And for the first time after they implemented, we had a drop in foreign arrivals and foreign tourists to South Africa. First time since 1994, because this is an excellent tourist destination. It is a very, very high value, high quality tourist destination. Of course, initially they didn't want to change it. The motive behind those changes were noble. All right. I'm not sure, you know, trafficked children will come through aeroplanes. Might be in a container in a port in Durban, but not aeroplanes. But nonetheless, the notion was a noble one. And yes, they could have dropped those and eased those visa requirements a lot sooner, but they did eventually do it October last year. I spoke to Sun International's board and their executive. I spoke to Sorga Sun. They had a fantastic final quarter. The numbers bounced back immediately. And the weaker the rand gets, the cheaper South Africa gets. And we've seen tourist numbers have picked up. So that might augment spending. That might support the services. Because you now have foreign tourist spending in South Africa and coming in numbers. So there have been some positive developments. And let's hope that there's more on the policy front. So yes, you can turn it around. It's just, in our view, unlikely. And then the biggest constraint here is going back to electricity capacity. I told you, we can't grow by more than 2 or 2.5% unless we finish those power plants. Which doesn't seem at this point to be going a lot faster. I mean, they've not been turning out the generating units left, right, and center. Although I must say it confuses me. Because I was always taught you have a big bulk investment, all right, in any capital project until you get to a certain critical mass. And then there has to be some economies of scale. So you would think once they've got the one unit up, the next one, the next one, the next one, the next one would follow a lot quicker. But obviously I am ignorant. All right, so I'm just saying that is the case. So that is our picture. Throughout this period, you've got short-term hikes in interest rates, and then they start to come down, but you've got consistent pressure on the currency. All right, and that just reflects our value relative to other countries' values, and that also reflects the dynamics and anticipation of US interest rates continuing to normalize and going up. All right, so that's the story, really. That's all there is to it.